Chris Jones here with the next video in our 24 rules for a successful business exit. If you like these videos, please like and subscribe. Now, depending on who you are, today's topic could be your favorite or least favorite subject matter. We're going to begin the discussion of structuring and negotiating the deal. You've probably heard stories about deals falling through at the last minute, buyers getting cold feet, or even trying to change the terms in the 11th hour. Well, many of these challenges can be mitigated by understanding the basics of sales structure, and it's the theme of today's video. Rule number 18, know the 4 basic elements of a transaction. As we reviewed way back in rule number 7, selling your business is not just about price. Price, of course, is important, but it's only one of the 4 key parts that you need to be keenly aware of. And each of these elements will ultimately have an impact on your taxes post-exit. Your deal team, including your attorney, accountant, and business broker, should be well versed in these areas. The first element is transaction structure. The majority of small business sales are asset sales. In this case, the seller keeps the actual legal entity and sells the tangible and intangible assets of the business. The buyer acquires these assets with a newly formed entity. In a minority of cases, though, small businesses are sold in what's called a stock or equity sale. This is when the owner sells the company shares or member units to a new owner and transfers all the assets and liabilities to the buyer unless they are specifically excluded. Most buyers of small businesses prefer an asset sale so they can avoid the potential for any unknown liabilities that occurred during the current owner's watch. There are big tax implications as well, which we will touch on later. The second element in a transaction is the sale price. When you accept the buyer's offer, you agree to the buyer's price. But there is a chance that the figure changes before closing day. So let me explain. During due diligence, the buyer may uncover issues with the business they weren't aware of, such as big customers leaving. If they are material, they may seek some concessions. This is where negotiation skills are important. You could agree to make a small concession on price, for example, but at the same time require a more favorable tax allocation, reducing your tax burden and perhaps resulting in the same net after-tax proceeds or better. Speaking of taxes, our third component is allocation of purchase price. This component is often misunderstood and overlooked by business owners and buyers. Price allocation includes tangible assets like equipment and real estate, as well as intangible assets like goodwill. The bottom line, allocating the price of these different buckets, remember back in rule number 8, has a huge impact on your net after-tax proceeds. Last but not least, let's talk about the terms. This component outlines how the buyer will pay for the business. Where's the money coming from? All cash deals are rare. Even with SBA finance deals, the SBA requires the seller to carry a 10% note to be paid over several years by the buyer. Outside of SBA financing, payment structures can vary widely, with 30% cash down and seller financing or 5 years being common. Well-crafted seller financing can bridge the gap between the buyer and seller on price, and maybe even fetch a higher price. Seller financing can generate tremendous interest earnings for a seller as well, and in many cases defer taxes. When we provide business owners with a complimentary value range, we touch on these 4 elements. We even pre-flight the business to our financing department to see if the business is bankable. We've covered the 4 elements of a transaction. If you want to learn more about this topic or how to value your company, you can check out more of our videos here or give us a call anytime. See you in the next video.